Good afternoon, everyone. My name is Toya Hemingway, and I am chapter chair here at SCORE Chicago. SCORE is a national nonprofit association dedicated to helping small businesses get off the ground, to grow, and to achieve their goals through education and mentorship. We have been serving the needs of business owners across the country since 1964. Here at SCORE Chicago, our mentors are experienced entrepreneurs, corporate managers, and executives with backgrounds in a diverse series of industries and specialties who volunteer their time, their experience, and knowledge to help small business professionals start, develop, and grow their businesses. We offer free and confidential mentoring on an ongoing basis, as well as low cost or no cost business training and free online workshops, in addition to numerous templates and tools on our website. If you're interested in being mentored, please go to score.org and submit a mentoring request. Now it's my pleasure to introduce today's presenter, Jeff Nicholson. With over 33 years of commercial and investment banking experience, Jeff was responsible for the client coverage activities of diversified companies across the central US. He has he has had the opportunity to observe and work with managers and owners across a wide range of industries, from large public multinationals to small privately held companies. During 17 of those years, he was also a successful adjunct instructor at both the undergraduate and graduate levels in both management and finance. Jeff, thank you very much, and it's the platform.
Well, thank you very much, Toya, and good afternoon to everybody. I'm going to be your guide today for financing your startup, and I very much appreciate everyone listening in. When I was first asked to put this together, I thought to myself, all you need to do is sketch out your great idea on a napkin and people are going to throw money at you. Well, I guess that's not really true. Money is really like gasoline during a road trip. You don't want to run out of gas. Now, this was a quote by Tim O'Reilly, who was founder of O'Reilly Media. And O'Reilly Media was the creator of the first internet web portal in 1993. Our goal today is to learn a lot more about funding startups. And most people who claim to know really don't know diddly about it. We're going to cover a lot of material. We're going to go a mile wide and an inch deep, so strap yourself in. Let's step back for just a minute and think about the big picture. Look at these stages during the life cycle of a business startup. There are roughly 9 major stages here on the slide. Now, this workshop is only going to focus on the 5 highlighted stages shown with the red halo. Most of the stuff on financing that you can read, most of the stuff you can find on the internet, and most of the workshops or webinars you can attend are all about those stages that are not highlighted. Why? Because the term startup is often used for a business that's successfully launched and remains alive for up to 2 to 5 years. That's not our point of view with this webinar. We're focused before the break-even level. So let's dig in. Inc. magazine went to its 500 founders. That's the 500 fastest growing privately held companies in America, and asked them to think back to their first year in business and identify the biggest mistake or challenge that they faced. And here's the result of that survey. And by the way, notice that number 2 is a very distant second. So the number 1 challenge to the Inc. 500 was not enough capital. Now, I know what you're thinking. Hey, that survey was taken 10 years ago, and you wonder whether that's still relevant. Well, here's the result of some diligent work done just a couple of years ago. CB Insights is a private analytics platform that provides market intelligence about private companies and investor activities. It's a big data type company. So the Startup magazine worked with CBI Insights and accumulated information on 350 failed startups. And they analyzed those failures. And the results of that work are displayed here. Notice that the two biggest reasons for startup failures are all about funding. The startups either ran out of money or couldn't find financing when it was needed. Now, the SBA says that the average cost of starting a business is roughly $35,000. That's average. Now, storefront businesses may require 2 or 3 times that, but most businesses will be able to launch successfully for well under $100,000. Now, a sound business plan includes specific financial projections, including total startup costs. And estimating startup costs, believe it or not, is as much about sales forecasting as it is about expense projections. Investors and lenders will want to know specifically where their funds will be used in the business. So to begin the search, you start with yourself. No one's going to invest in your business if you are not willing to invest in your business. We call that bootstrapping. After that, you have to get out a pad of paper and begin to list other sources that you might be able to tap. And a key objective of this workshop is to help you formulate that list of possibilities. And what form will the funding take? Will it be donation-based? Will it use loans? Will any of the funding come from sources that require an ownership stake in your business? As you're pulling together your thoughts on these sources, you really need to cultivate a funding strategy. And by strategy, I mean determining A, the mix of resources plural, that you plan to use. B, the specific milestones in your journey that determine how much and when the funding's needed. And C, how do you plan to approach each source in the process? Now, returning to that Inc. survey, another question they asked was, how much money did you use to start your business in that first year? And if you look, those answers aren't far off from what the SBA said. Only 18% of the repliers said $50,000 or more, and well over half said less than $10,000. So if that's the case, well, where do you go? Well, continuing on that survey, this is where they went to get their funding in that first year. 71% was from personal savings. That's bootstrapping. That was obviously the biggest source. 21% was from family and friends, and we're going to talk about that later today. And if you add both the personal and home equity loans together, that represents 25%. But recognize those sources actually put your personal assets at risk. They're not debt to the business. 9% angel funding, but notice on this list, there's not a single mention of a bank loan. And SBA guaranteed loans are only 3% of the sources. Now, with that as background, you may be saying, well, how do I get started on this? Well, I would start by trying to get answers to these two questions. How much money is needed, and how will it be used? Now, what do you think are startup costs? Well, most people make the mistake of thinking that startup costs only accumulate until the business is launched. But then that's not true. Take a look at this slide. On the far left side is day one, when the business is launched. But afterwards, your business will still need to operate until you reach break even which is where that yellow arrow is. And until you break even, you need to cover or fund any operating losses until your dream becomes profitable. And to complete this exercise correctly, you must be able to forecast sales revenue. So if you go back, cash outlays are the startup costs until break even is reached. And that includes capital expenditures, which don't show up on your income statement. So if you're going to buy equipment, like a copier or a stove and oven, that's part of your startup costs. We talked about the operating expenses or losses until you break even. And then there's another component called net working capital. Now, this is something that also doesn't show up on your income statement. It's on your balance sheet. So let's see if I can give you an example. Let's assume for the moment that you're manufacturing something. And in order to start, you have to buy some raw materials that you're going to make into a finished product. So you go out to ABC Company to buy some raw materials. But because you're a startup, they're not going to give you any terms. You're probably going to have to pay in advance of shipping. So on day one, when you make the order, your money goes out the door. And as they're processing your order and packaging up and shipping, you may not get it for a week or two, but your money's already out the door. Now, once you get the raw material, you have to make it into a finished product. And that manufacturing process may take, 2 weeks, it may take 4 weeks, and you still haven't sold anything, but the money went out the door day one. And once you sell to an existing business, and not a charge card sale, which you'd get reimbursed rather quickly, but if you sold to another business, they want terms. And they probably say, well, we'll pay you net 30, which is another 30 days in which you haven't gotten your money. So all of that time until you actually collect the money, the check clears, might be anywhere from 8 to 12 weeks of time. So somebody has to pay for all of that time that the money went out the door day one until you get paid by your customers. And that's what working capital is. And again, that shows up on your balance sheet, but somebody's going to have to pay for that initial inventory purchase until you get paid back. And that's all part of startup costs. So there's two components here. One is the one-time startup costs, like registering your business and getting all the legal documents signed and getting brochures and business cards or whatever, setting up a website. And then the monthly operating losses until you break even. And one last thing, if your household is dependent upon the success of the business that you're launching, then you have to add personal living expenses into your startup costs. That's all part of the story. So again, break even is the key thing here. And once you get there, then hopefully profit thereafter will help fund the rest of your business. Now, here's some guides to think about as you're preparing your cost estimates. Plan for contingencies or the unexpected. If you build a commercial building, you've got architects that have a great deal of experience. You have engineers that have experience. You've got contractors that have experience. But no bank is going to make a construction loan for that project without a contingency plan in the budget. And that's usually anywhere from 8 to 12% of the cost of the building. And so every business should also plan for the unexpected. Don't skip on necessities. I know a number of people that say, well, maybe I don't need to buy insurance. That's not something to skimp on. You can always figure ways to economize later, and you need to get a reality check or two on the information that you've pulled together. And that's where SCORE mentors can be very helpful. You can share your startup cost estimates with them and talk about the process, and they'll challenge you with questions to make sure that you've included the things correctly and have the right assumptions. Now, everybody write this down. www.5minuteclasses, all one word, 5minuteclasses.com. When you go to that website, you want to look for a YouTube video, how to calculate startup costs. Now, it's a good video, 5 minutes, but they also suggest some worksheets that might be helpful to you in pulling together your startup cost estimates. You also want to consider two things as you move forward. It may not happen right away. One is to try to get customer deposits or prepayments of some kind. It's always a way to help you finance that working capital. And at some point in time, try to get payment terms from your supplier. You could try for net 30, but you could settle for net 10 or net 7, just to give you some flexibility in financing those purchases. Now, as I said before, just as a reminder, if your personal situation at home relies upon the business, you have to make sure that your personal expenses are included in your startup cost calculation. Now, how do you pull this stuff together? Well, I've got a great solution for you. You can download what I think is the best Excel spreadsheet for compiling financial projections, and it's free from SCORE. So if you go to score.org and enter financial projections template in the search box, your result will be that Excel template, which you can download. It has input sheets. I think there's like 10 tabs on the spreadsheet. It has input sheets where you can enter all your assumptions, and the tool will also provide some suggestions to you on some of those assumptions. But once you've entered the information, the spreadsheet will generate income statements for you on a monthly basis for the first year and annually thereafter. It will generate balance sheets, cash flow statements, and it even has a break-even tab that provides you with a result. And it also provides some ratio analysis, which may be very helpful as you're approaching some sophisticated people to get some funding. I don't believe there's a better Excel workbook on the internet today, and it's free from SCORE. Now, we're not going to go into that. That could be a whole nother workshop by itself. But you should learn to use it and assembling your business plan. Now, in addition, by the way, there's also a 40-page user guide, which you can download. And there's also a complete sample workbook that you can also download. I think it's Ann's Nursery. So you can see all the information that Ann put into her nursery startup, all the assumptions and all the output from pulling all that information together. It's just a great tool. Now let's switch gears for a minute. The likelihood that your startup will get financed by a bank is slim to none. In over 30 years of banking, I financed only one startup. And it was for $1 million loan. And one of the founders' fathers had a stock portfolio of $1.5 million in current value. And so the bank required that the father pledge that $1.5 million portfolio to the bank. So I put those certificates in the vault. I also had the father execute stock power certificates for every stock, so that now we owned it and we could sell it at a moment's notice. And that's the only way that I ever made a startup loan. So let me help you understand how a bank thinks. Let's start by pretending you're an investor. You're going to invest in a public company, which means you're going to buy some stock. Now, you know, if you buy stock, if the company goes bankrupt, you could lose everything, right? But you take that risk because you want to participate in the upside of that company's future. You're hoping for the next Google or Microsoft or Amazon, right? Now put a banker's hat on. Now, when a bank lends money, it too could lose everything if the company goes bankrupt. But the bank does not have an opportunity to participate in the upside of that business. So if this is going to be the next, Morton Steakhouse or whatever, all over creation, and they're doing the first one, they can't participate in that upside because their upside is capped by the interest rate. And because they can't participate in that upside, a bank wants to be assured that they can be repaid in two ways, two legitimate sources of repayment. And the first one is cash flow from the business. So when you give a bank your financial projections, they're going to recast their numbers to be conservative. They're going to take a look at other businesses in your space to see how they perform, because you don't have a history. They're going to look at other companies' histories and try to incorporate that and to come up with some more conservative, realistic approach in their minds. And if you pass that test, meaning that the cash flow is sufficient to repay the loan, now they're going to look for their second way out. And that's usually the liquidation of collateral. And so they'll look at the receivables that are going to be on the balance sheet, and they're going to say, okay, maybe we can liquidate those for 75 cents on the dollar. We're going to go to the customers and say, hey, the company's bankrupt. We'd like to collect what they owe. And some of those customers are going to say, well, we're not going to pay you. We're going to send the material back. So that's why there's a discount. The raw materials that are sitting in the factory, they probably won't get more than 40 cents on the dollar, 50 cents on the dollar, because they're going to try to sell them back to the suppliers who know that the bank's in trouble. So they're going to require a discount. And the finished goods, there you can try to sell them to customers that are existing, but they too will know, with the bank selling the material, that they can get a discount. And maybe that could be a 40-50% discount. And the same thing happens with the equipment or real estate. There's always a liquidation discount that's going to, so they add up everything, and if it can repay the loan in a liquidation setting, then they make the loan. But if they don't, then you don't get the loan either. But you see, startups have neither a history to demonstrate cash flow predictability, and you don't have any collateral. You're looking for the loan to buy something, so you have no collateral to start with. And that's why banks do not lend to startups. Where can you go? Well, here's the list. And each of you should be thinking of multiple sources. Now, you've got two columns here. One is equity on the left, which means you're going to give up some of the ownership of the company in order to get sources from there. And debt doesn't usually require any ownership, but it has to be repaid. The equity doesn't have to be repaid, the debt does. Now, you see this asterisk at the bottom, guaranteed by SBA. Well, the SBA really doesn't lend money, but it guarantees loans that are made by other financial institutions. So banks and credit unions can get support from the SBA to make loans to startup companies. And if you go back to the working capital example that I gave you, let's assume for the minute that the bank has added all of those liquidation values from receivables and inventory and equipment and real estate. And for that $100,000 loan, they figure they can only get 50 cents on the dollar paid back. Well, the SBA can step in and say, well, we'll guarantee 75% of the principal of that loan. Now the bank sits there and says, well, no, wait a minute. If I liquidate in a bankruptcy, I'll get 50 cents on the dollar. And the SBA is going to give me 75 cents on the dollar. So I'm going to get $1.25 for every dollar of loan. That sounds good to me. We're going to make the loan. So that's how the SBA works. Now for the fun stuff. I know this looks like a very busy slide. Look, I put this together to present to some Chicago businesses back during the Great Recession, because they did not feel that they had adequate access to conventional bank financing. So if you look at this complicated mess, these are sources of capital, but there's not a single bank included. So we're going to focus on those clouds that are highlighted in grayish blue. Those are the ones that have potential applicability to startups. Again, the whole focus here is from your idea to breaking even. So that's why we're picking these. Now, the other clouds are typically applicable to companies that have been in business for some period of time, successfully for some period of time. And that means companies that have at least a track record of operating results for a year or two. So we're going to start right at the top of the page with micro lenders. Now, micro lenders are primarily intermediaries between sources of funds directed towards disadvantaged areas and the actual financing needs in those areas. And that's why micro lenders they're really not for profit and they operate very locally. The Community Reinvestment Act actually requires banks to lend to disadvantaged areas. So banks contribute or provide funds to micro lenders, and they even participate shoulder to shoulder directly in extending loans with such lenders. And that's so that they can get CRA credit every year and comply with that federal law. Now, the micro lenders are typically certified by the U.S. Treasury Department as Community Development Financial Institutions, or CDFIs. And there are 950 of them in the United States today. Now, some programs can also get support from the Small Business Administration through its SBA microloan program, where the SBA guarantees 85% of the loans extended. And there are 32 such lenders in Illinois today. The key here is that your business needs to qualify because of low income or disadvantaged areas. So it's typically friendly to minorities and to women. And unlike banks, micro lenders are much more friendly to startups as well. Now my experience is that much of this lending is directed towards real estate and real estate development. But it's also available to startup companies for working capital and equipment purchases. Now, some of the loans are secured with collateral, and that's especially true with the real estate loans. Sometimes co-signers are required, but in many cases, these loans are unsecured. There's no collateral. Typically, these loans are for $50,000 or less, and the rates vary nationwide from 4 to 36%, which is depending on where you are. Now, the SBA microloan nationwide average rate of 7.5%. I just looked up this morning for 2022, and the SBA microloan averages were $13,000 in size, and the average rate was 7.9%. So now you're up to speed. Now, Axion, the Chicago Network Initiative for Microfinance Group, and CFA USA are probably the three largest micro lenders in Chicago, and that was on that slide that you saw earlier. But to find out more, you can go to the CDFI Coalition at cdfi.org, and that's the trade association for all of these micro lending institutions. So there's a lot of resources there to look at. And the Opportunity Finance Network, or OFN.org, is a group of CDFIs that have banded together in order to make the required lending dollars work for them. So that's one source. The first one, micro lenders, there we go. Now we're going to go to family and friends. Now, believe it or not, family and friends invest between $50 and $75 billion annually in startups. This is 2 to 3 times the money invested annually by angel investors or venture capital companies and startups. So as a participant in this webinar, you're going to receive a copy of SCORE Chicago's Family and Friends Funding Guide. It was put together by a very bright banker, me, and it's 5 pages, gives you a lot of information, and you'll get that as being a participant in the webinar. But probably the trickiest part of family and friends financing is that you don't want to lose their money, right? So if they invest in you, you don't want to lose it. So you're walking this emotional tightrope by mixing business and family and friendships. So my advice, go only to people that can afford to lose it. This is the most heavily weighted criterion in my judgment. Now, you're not expecting your business to not launch, but let's face it, there's a risk of that. And even after you launch, there's a risk that you won't break even. So there's a real potential to lose money. And you should also approach people that are sophisticated and well-connected, because they're going to ask you the tough questions that will ultimately benefit your company in the long run. Better yet, aim at individuals who have experience running their own businesses, because they know what you're going through. But I say target 5% or less of the net worth of an individual as a frame of reference. You know, if you go to a pension fund or an institutional investor or an investment manager, their clients, the advice to their clients is, if you're going to want to invest in a risky asset, that's okay, but it shouldn't be 5%. It should be less than 5% of the total portfolio. And in this case, you should be looking at less than 5% of the net worth of the individual that you're talking with. And that's because they could afford to lose 5% or less. And avoid taking dumb money. You know, you want your seed investors working for you to help the next round work, so that you've got some people that can testify for you. Dumb money doesn't do that. And certainly don't press for money from someone who's uncertain, because they're going to be the first ones to complain if there's anything that goes rocky. Certainly avoid talking to people where there's a high potential of drama and stress. You're going to have enough of that in your business to start with. Now, once you have a target, build a relationship first. Ask the target for their reaction to your startup business concept and business plan. You're going to be much better positioned to ask for money later. You need to be prepared. You should have a business plan that includes a validation of the market for your product or service. That's very key. And it also has to include those financial projections. I think milestones are important, not just for funding, but to kind of identify how your business is going to evolve. But you can use milestones as a triggering event. That allows you to take a series of smaller funding requests and then communicate on the process as you go. We'll come back to milestones in a minute. Now, most of the capital that you'll raise from family members and friends will take the form of loans. They want to be paid back. And you have to decide what works for you. And the family and friends handout will go into detail on distinguishing between whether equity or debt makes sense. But as you're talking with these people, you should put your cards on the table. Even though you're confident in the success, be honest about the risks that you face. And don't make promises you can't keep just to get someone to open up their checkbook. You know, if you look at a public company today traded on stock exchanges, they file every year a 10K report. And in that 10K, in the front of that 10K, they have an entire section that says risk factors. And management identifies a veritable host of risks that they face in their business. And then they articulate how they plan to mitigate those risks. And you need to take that same mental approach as you have contact family and friends for funding. So be honest about the risks, because they're going to ask you how you're going to navigate around them and mitigate those risks. Now, be sure to demonstrate your passion and your diligence. You know, having a great idea is one thing, but proving that your idea has traction out there because you validated it in the market, that's another thing altogether. And you should manage expectations. It's a best practice to send periodic emails or texts about what's going on to your backers. Be honest about what's going well and what could be going better. You may want to come back and get funding from them, either from another milestone or another stage in your business. And so that communication process kind of helps nurture that potential. Remember, no lender or investor likes surprises. So endeavor to alert each supporter of any suspicions that you have that are showing a change from your expectations. So that's the bit about family and friends. Now let's talk a little bit about milestones. Again, this is not just a list for funding purposes. You can also use it as you can think about your milestones in your business plan. So proof of concept. So once you can technically demonstrate that your product can be made, that's a beginning milestone. I like the key partnerships as another key milestone. You might be looking to have a website designed. So once you have engaged a website designer, that's a time to go back to a family and friends funder and say, okay, I've got a web designer. They're going to require, you know, $1,000 to build my website. I need $1,000 from you. Or it might be that you have somebody that's going to work on your social media platform. And again, that's another key partnership milestone. It might be fulfillment. You get somebody to fulfill the orders for you. All of those things entitle you with an opportunity to go back and ask for another bite at the apple. You know, proof of market, prototype, completion of the website's another one to think about, because once you get the website completed, now you're going to have to worry about the potential orders and that thing. Minimum viable product, this very big thing with lean business startups. So that's where you've produced a low-cost version of your product that you can take out to the marketplace and people can touch it and feel it and experience it. Once you've got that minimal viable product and you're going to go test it in the market, that's another opportunity to ask for funding from family and friends. And of course, beta testing, which is the final testing version before you launch. And maybe the first sale is another opportunity. Hey, I've made my first sale. Time to ask you for some more money. Anyway, the milestone approach helps break funding requests into bite-sized pieces, and it's something I highly recommend. Now, back to this busy slide. Now we're going to talk about donation funding. Now, donation funding is a subset of the broader crowdfunding. You know, crowdfunding is raising money through the collective efforts of individuals and institutions coordinated through an internet platform, right? And any money raised through donation funding doesn't have to be paid back. It's a gift. And donation funding has actually helped launch over 1 million businesses since 2000, when it really started. And the biggest players in that space are listed on this slide. Now, this is where a business plan is probably not going to be of much use. You know, these platforms attract donors that are interested in projects and in causes, not necessarily businesses specifically. So you kind of have to change your thought process in order to align with the platform populations. And you've got to have a story that connects. I got a great example. There was a woman here in Chicago that wanted to start a child transport business for working couples. It's a hassle and a mess for two working people to get their kids to school, right? And so what she wanted to do was to develop a business that she would transport the children from working couples from their home or apartment to the school and back every day to relieve that pressure, obviously for a fee. And when she went to get insurance for her business, the insurance companies categorized her as a limousine service and therefore required, because she was a startup, a $10,000 upfront payment. And she didn't have the money. So she went to the platform and she told the story about what good she wanted to do for working couples, and this was going to relieve a lot of pressure for them on a daily basis. But the big bad insurance company was requiring $10,000 and she didn't have it. She got the money. Most of the platforms offer rewards of some kind. Now that could be a pre-order before a launch. It might be discounts from the first run. It could be recognition like a t-shirt or be on a donors list, but usually there's some sort of reward. And what you need to do is to look at each platform opportunity and evaluate the assistance that they give to any campaign so that you can gauge what platform works best for you. And this should not be viewed as a one-time event. You should treat givers or donors as ongoing stakeholders that might assist you in the future. You know, the platforms, they provide you the donor lists, the dollars that were given, they provide vehicles to gather contact information, and you have to gauge what works best for you. But going back to the donor population has been very successful. Peak Design, it's a creator of outdoor camping and hiking gear. They've gone back to their donor population 5 times. And the 5th time was for a big one. They raised $4.9 million. But you also need to formulate your own outreach program independent of the platform. You need to communicate with your friends, with your family, with potential suppliers, and other interested parties. You need to draw them to the platform so that they can potentially contribute as well. I cannot stress that enough. Just relying upon the platform to communicate your campaign is insufficient. You have to add to it yourself. Now, the campaigns can either be fixed or flexible. Fixed is if you don't raise the total amount requested, you get 0. And the flexible, you keep whatever is raised, but the fees are typically doubled. And so the fees are charged against that total amount that's raised, but each pledge transaction has a processing cost with it because there's banks involved to, collect the money and charges and all this other stuff. And that can go up anywhere from 1.5% to 3% on top of the platform fee. It's interesting that all or nothing campaigns, the fixed campaigns get fully funded at twice the rate of the flexible ones. And that is only common sense, right? If you're going to work to raise money, but if you don't get the last dollar, you get nothing, you're really going to work hard to get that last dollar to reach that dollar amount. Now, the average donation campaign raises between $25 and $30,000, but the whole process lasts as much as 9 weeks. And the average pledge is $100. And typically the average number of backers is 40 to 50, but the fully funded ones usually have about 300 backers. The biggest raise ever was $20.3 million on Kickstarter. Pebble Technologies was promoting a new smartwatch, and their target was $500,000 for marketing. They raised $20.3 million. And 2 years later, Fitbit bought them. And the last thing is important. Campaigns with videos earn 100% more than those without. So that's a bit about donation funding. Now let's jump to angel groups. You know what an angel is? An angel are usually wealthy and successful business people who are interested in investing their own money in startups and in early stage businesses. Sometimes they work alone, and sometimes they're part of a group. If you've ever seen Shark Tank, and if you haven't, you should, but Shark Tank is a great example of what angel investors are all about. And on this slide, you see the top 7 angel groups in Chicago. Now, there is a difference between individual angels and angel groups. Angel groups are obviously more formal. They usually get involved because they anticipate they're going to be part of the next IPO or unicorn. And by the way, seed capital on this slide often refers to the first of 4 funding stages for a growing business. Now, angel investors are typically more interested in ownership or equity than providing debt capital. And if they do provide any debt capital, it's usually convertible into equity. But angels are not interested in running day-to-day operations. They leave that to you. They're routinely satisfied with only a minority stake in the business. And the vast majority provide advisory support and mentoring support to you because they want to have their money blossom. And probably 1 out of every 3 angel groups actually wants to have a board position in order to participate in major decisions. But they have a shorter time horizon than other potential investors. 2 to 5 years is typical. They want to get out entirely or partially in that time frame. So they want to recoup their investment so that they can redeploy it somewhere else. The average individual investment is about $40,000, so keep that in mind. And just as important, if you've watched Shark Tank, is that valuation of the business is critical to your success with angel investors. And we could spend an entire workshop talking about the valuation process. Just know that it's important to understand valuations in the recruiting of potential angel investors. Oftentimes, angels see themselves as filling the gap between family and friends funding and investments from venture capital firms. And more angel groups, when they look at a funding opportunity, they won't even consider looking at it if it hasn't raised money from family and friends. Their position, after all, if family and friends who know you best aren't willing to invest in your business, why should we even look at it? Now, I believe there's a greater chance of landing an individual angel investor if your business plan is not targeting a near-term IPO. So if you're looking for a patient investment capital to support your startup, for mentoring support, your time horizon is out beyond 5 to 7 years, an angel investor is your better match. But if your ambitions are more aggressive, then this is the list of the things that you need to have in place in order to attract the capital from an angel group. Your product or service is developed or very near completion, number one. And you've got existing customers or confirmed potential customers. A lot of times during the MVP process, when you're showing your product or service to people and drawing them to your website, there's a chance to pre-order the product. And that's where you've got some confirmed potential customers. You've invested your own capital, and like I've said, you've recruited family and friends funding as well. And you can demonstrate that the business can grow rapidly in the next 2 to 5 years. And that's where your financial projections and assumptions will support that demonstration. And you also may have to make sure that your business plan is in top shape. It's definitely easier to find the angel groups than it is individual angels. I mean, earlier I showed you the 7 biggest angel groups in Chicago. And in any of these situations, it's best to be able to find an introduction into a group or to an angel. That's why it's critical to network. If you're not on LinkedIn, you should get on LinkedIn. It's a way for you to navigate through people to get into the eye shot of somebody else. Now, the Angel Capital Association, or ACA, is the main trade association representing angel investors in the US. It's a great resource to find studies, characteristics of angels, and white papers all about the angel environment. So if this is a key target for you, go to aca.org and take a look at what information they have. Angel.co is another website. Actually, you can post for a job in a startup, or you could recruit for your startup through angel.co. That's one of the functions. But if you go to the web address I've listed here with /North American /investors, you'll be able to get a long list of individual angel investors in North America. And then you can start to work with that list to see, whether any of those people might be good targets or not. And the Angel Investment Network is the largest crowdfunding platform in the angel world. They boast, 250,000 investors across 80 countries. So angel investors, a great resource. Here's where you can learn a lot more about that environment. Now, let's take a brief detour here. Folks have asked about credit cards in the past, so I've added this section. Business credit cards can indeed be helpful for startups. So let's first assume that your business has launched successfully, but you're short of break even. That's where this works best. So long as your personal credit is healthy and you have the income to prove that you'll be able to pay your bills, obtaining a business credit card during the infancy of your business may not be particularly difficult. And by healthy, I mean the minimum credit rating is between 670 and 690. Most business credit cards will require a personal guarantee, meaning that you as the business owner will have to personally accept responsibility for any debt incurred with the card. And most issuers will hard pull on personal credit, so your score will drop by 5 or 10 points right at the beginning. So if your rating is good and you can show adequate income, this can be a real source of funding for you. Virtually all credit card applications are made online. You're going to be asked to provide the legal name of your business, the address and phone number. Is it a corporation, an LLC, a partnership, or a sole proprietorship? And what kind of industry are you in? How many years have you been in existence? The number of employees and the annual business revenue or sales. That's all going to be asked for. And because you're a guarantor of the debt as well, the issuer is going to want to know all about you. So you're going to have to provide your personal details, including your personal gross annual income, and they're going to check your credit score, as I said. But what if you haven't launched yet? Generally, you need a business to open a business credit card. But you ask the question, what exactly is a business? It is possible to get a business credit card if you earn money independently. Now, this could be your current job or part-time income that you get by selling goods online or being an Uber driver or freelance writing or doing consulting work or any activity. You can include those income details as part of the requirement. You list yourself as the sole proprietor in the business tax identification section, and you use your Social Security number rather than an employer tax ID number. So you don't necessarily have to run a company in reality to get a business credit card. But these cards are specifically geared towards business owners and people that have business expenses. Now, that includes startup costs. And the APRs are typically between 20 and 30% or more. Now, what about entrepreneurs without good credit and income? Well, for many startups, a business credit card can be difficult to obtain without adequate personal credit. Now, if you have bad credit or no credit, your business credit card options are really severely limited. But you're not without options. A secured business card may be a source of help. Now, with a secured business card, you open your account with a security deposit, usually a minimum of $200 to $500, but it could be more depending on your needs. And upon approval, your credit line with the card will be equal to your deposit account. Now, here's where you could be using family and friends to make that deposit for your credit card. It's got a specific use and a way to you to focus on that. Now, everybody write this down. www.creditcardbroker, all one word, creditcardbroker.com. This is a website, a pretty good website that is designed for people with little or no credit. It gives you a lot of resources to use and gives you access to credit cards that might be available to you in that circumstance. Now, you can also try to get a business credit card with a cosigner, but that's pretty rare. But there again, that's where family and friends might assist you by being a cosigner. You can also get someone that you trust to add you as an authorized user of their credit card. You'll be able to use their account to make purchases. You can even get your own card with your name on it. And at the end of the day, you're really not liable for those purchases legally. But again, it's another option in order to make purchases for your startup business. Now, although a credit card company could ask you to provide income verification, they often don't check it. But what happens if you exaggerate your income? Well, that's considered loan application fraud, and it will definitely come back to bite you. If you're convicted of loan application fraud, most issuers will file a class 4 felony. And that has a prison sentence from 1 to 3 years and maybe up to a $25,000 fine. But some file a class 2 or 3 felony. And now the prison time is 2 to 7 years or $150,000 to $200,000 fine. And as I say here on the slide, the maximum is $1 million and up to 30 years in prison. Now in Illinois, the Illinois State Police Bureau of Identification will report these convictions, and they are discoverable by employers, creating a loss of future job prospects for you. And further, a conviction will probably result in blacklisting by all lenders. So it obviously pays, to be honest, as you try to navigate through this business credit card business. Now, back to the slide. Now, these are the sources that we didn't cover today. And equipment finance is possible for startups, but only if you're dealing with the manufacturer, because the manufacturer understands best the depreciation prospects of the equipment you're buying, and they can structure a lease, which doesn't require a down payment, by the way. They can structure a lease to keep them above the liquidation value. So that's a place to go if you're buying equipment, is go to their leasing arm if they have one. Factoring is another possibility, but typically you've got to, you don't have to, you have to have launched your business and actually be in operation, but you may not be break even. And what a factor does is they take your receivable from a creditworthy company and they will buy it from you effectively for anywhere from 75 to 80 cents on the dollar. So if you're doing business with the likes of a Target or somebody like that, and you've got the receivable for a $10,000 order, you can go to a factor and get 75 to 80 cents on the dollar right away. So that's possible for a startup that's actually launched but is not at break even. Now you also see Lendio.com and Fundera.com. These are platforms that help connect entrepreneurs with other sources of capital. But again, to use that, you have to be in existence for a while. So I include them here so that you'll be aware of these things after you break even. The Illinois Investment Network is like Lendio or Fundera. It's a web-based portal that matches investors with entrepreneurs. It's a no commission service, which is great, but they have fees for as little as $149 for a 180-day listing. But again, it's for established businesses. So once you get established, you could go to this network and put a listing out there to raise money, and it's $150 for 180 days. That's a pretty good deal. Now, the lines have been blurring a lot between crowd lending and alternative lenders. So if you look at this slide, these are probably the largest alternative lenders. You've probably seen commercials for many of these. Cabbage On Deck, for example, is a public company, big public company. And this is where businesses can get financing. But you really have to be in business a minimum of 4 to 6 months. And normally they're looking for 12 to 18 months as the normal gestation period. And they are focusing on consistent monthly revenues. They don't like to see a lot of variability in your monthly revenues. They want to see it very stable and consistent, predictable. And the reason is they take payments out of your account on a daily or weekly basis. You don't write a check to them, they come and take the money out of your account. Now they will tell you that they don't have an interest rate. And I've done the calculations, by the way. What they tell you is, oh, we have a factor rate. So it might be like you have to repay 1.2 times the principal that you borrow. And usually it's a upfront term loan that you're making. And it's usually for 6 months. But I've done the work to calculate that their APRs are between 30 and 50%. Now that's like dealing with the mob, right? But millennials are using alternative lending a great deal. So if they've got a business and they've got a chance to make a big order successful, but they don't have the capital raised to buy the material, they do the calculation and say, okay, we're not going to get the profit that we would normally get, but if we can demonstrate we can make some incremental profit after the interest cost within the next 6 months, and we can get this project built and sold in 6 months, maybe this is something we should do because we can put this great company on our customer list and attract more business. So that's alternative lending, but again, it's for established businesses. Now, you've probably also read about equity platforms and Start Engine. Mr. Wonderful, Kevin O'Leary's been all over the TV about this product. Initially, they were saying this is where startups can get their money. There again, it's like, well, what do you mean by startup? Is it a company that's been in existence for 2 to 5 years, as most startups are referred to? The answer is yes here. Even though there's 50 of these registered portals in the United States, you need 2 full years of audited financial statements in order to even participate in this. But again, this is for your future reference. As a reminder, we wanted to just focus on your startup idea through the time of break even and where can you get sources of capital to help you make that happen. And as you think about all of these pieces, I'm sure that your head's swimming a bit when you try to kind of piece them all together. One of the other things that you'll get by being a participant in this webinar is a picture, a great picture about how startup funding works. And I'm hoping that this picture will bring all the pieces together when it comes to the complex funding stages from beginning to end. So the picture is pretty large, so I couldn't fit it on one slide. So I'm going to be toggling between these 2 slides. So the first slide is the various stages, and the second slide is splitting the pie, splitting the ownership pie. So when you start at the idea stage, you're the founder, you have 100% ownership, as it says at this point, of nothing. And let's assume for the minute that you decide that you really need a co-founder. You need to shore up some of the skills, and it would be nice to be able to work with someone. So now let's assume you're at a 50-50 split. So you've got 2 founders and each of you now own half of the company to emerge. Now, at some point, you're going to actually need real money. So that's where family and friends comes in right away. So let's assume that you go to Uncle Fred and he can afford to lose $15,000. So he's going to invest $15,000 in your business. And that's in the lower left-hand corner, you can see $15,000 family and friends. So for that, he wants an ownership stake. And on this slide, it shows 5%, and that's because there's this option pool for employees. Just disregard that, it just complicates things. The idea is each of the founder's shares goes down by the amount of ownership that Uncle Fred now has. Now, 6 months after Uncle Fred has given you the money, you're starting to run out. And now you need more money. So now you want to approach angels. That's the seed round. And you want to go to the angel investors. And in this case, now you have real financial needs. And what you need is you need, again, over the $15,000, you need $200,000 to make your next series of things happen. And so another valuation will be made by the angel or angel groups or whatever. And if the business comes out to be worth $1 million, you can get your 200,000. So let's assume that it does. And now they're going to invest 200,000 in your business, and they're going to take a slice. In this case, it's like 17%, but Uncle Fred's share goes down, as does the ownership stake of the two founders as well. So your business is steaming along, you're hiring people, you're growing, and now you want to scale it up, but that's going to take some real money. So your next step is a Series A, which is usually going to venture capitalists, one or more venture capitalists, to get the money. And in this case, you've determined that you need $2 million of funding in order to scale your business. And what that means is you're going to have a $4 million valuation. So let's assume that the venture capitalists come up with that. And now the venture capitalist owns a third of the business. Uncle Fred's slice is scaled way back, as is the angel groups and the founders. And you can see under the word "the" how all of those shares of business have now been altered. The splitting of the pie has changed because the investment of the venture capitalists have altered the landscape. And so now someone comes to you as an investment banker and says, I think we can take you public. And you're persuaded to go public because you know that this is the right avenue for success for you and all of your employees. And so you're persuaded to go public to raise a whopping $235 million. And you can get there because the investment bankers believe your business is worth $2.6 billion. So once that IPO happens, the public now owns 8%, and everybody else's shares decline accordingly. But in the process, you've gone from owning 100% of nothing to owning 17% of a $2.7 billion company. And that's really the way multi-stages work for companies that are actually going to go public. These are the stages and how they fit together. And it gives you an idea of how some of these pieces have to fit together to make it work. And hopefully when you get that picture by email, you'll be able to make sense out of all of that. Well, we were supposed to learn a lot more about how to fund your startup business. I told you it'd be a mile wide and an inch deep. And I hope we accomplished a lot today. If nothing else, I hope I made you think. Thanks again for signing on, and I'll stick around to answer questions.
Let's see here. I am sorry. This is Toya, and I'll just ask the questions for you. There's the first question is, does this formula apply to existing businesses? And this came up early on. So like shortly after you started. So I'm
Okay.
not sure which formula they're referring to.
Well, if they're talking about the entire presentation, the answer is yes. If you're an existing business and you're looking to raise more capital, all of these sources are available to you, whether or not you're a startup or not. And that's where the whole thing with all of those clouds, if you're an existing business, all of those clouds are probably available to you.
Okay. The next person is actually making a comment, and the comment is this it's I'll quote. So this kind of sucks for people from poor families. Generational wealth is so important. In my family, I'm the one with extra. So I will have to focus on raising it through strangers. So, but it does point out that a lot of times when businesses are starting, they do have to rely on people who do have funds. And if family and friends don't have it, then you do have to rely on your resources.
Mhm.
Okay. So they wanted to know another person wanted to know that this broadcast was being recorded, and it is, and it will be available on YouTube. And the next person wanted to know about locating the slides, and they also will be available. Another person wants to compliment you. They said that you're a guru for them.
Thank you.
Michael wants to know, is it best to cold call investors at groups and ask them for a pitch?
Cold calling is not advised. I think, as I mentioned, the best way to get access to investors is to network in. So you go to an investor group, whether it's an angel group, a venture capitalist, or whatever, go to their website, sign up to be on LinkedIn, and find out businesses that they have invested in. They will show you on their website who they've invested in. They will probably also show you a number of the people that are mentoring or providing guidance to their investor targets. And that's where you can collect that information and through LinkedIn, try to network into the company. So if you know someone, for example, that is being funded by an angel group, then you can contact them and ask them to make an introduction for you to the angel group. And that's the best way to get into someone, is to network in. A cold call, my guess is that you've got a 1 in 100 chance that a cold call will result in even a screening.
Shirley is asking, she purchased a building, she needs funds to rehab it as well as start the business, and she received an NOF grant for $250,000. Do you have any advice for her?
Depending on whether or not that will complete everything you need, I think, again, that's where a micro lender and family and friends can help to potentially supplement turning, once that turns into something usable, how to actually outfit it correctly.
Okay. Nathan asks, considering the lower interest rates, what are your thoughts on using some home equity to fund startups, HELOCs, or regular equity loans?
Well, that's, if you remember the Fortune, I mean, the Inc. 500, 25% of the respondents said that they use those kinds of loans. And that's always a possibility. You just have to recognize that you're putting your personal assets at risk, because you can go ahead and take a home equity loan, but if your business fails, then they can take your house. And if you want to take that risk, that's totally up to you. But that's the line that you're drawing, or the line that you're erasing, the between your business and your personal assets by doing the HELOC.
Okay. In the chat, some questions. How would you alter some of these suggestions for nonprofits?
I have to tell you, I really don't have much experience at all in nonprofits, so I can't really advise you much there. There are some people at SCORE Chicago that have that experience, and I think there's a couple of programs on not-for-profits for grants and things of that nature, and I would refer you to that because I just don't have that experience.
Okay. And I concur. There are mentors who do have a background in nonprofits and can offer some advice on that. Okay, so hello, says Patrice. You showed all of the lenders that do not benefit startups, but which lenders do benefit startups?
Well, if you mean banks, there aren't any. I mean, I showed you a complete portfolio, if you will, of sources of funding that are not banks. And some of those are equity, some of those are debt. But a startup, before you break even, you're not going to get money from a bank.
Sorry, noise outside my window. Okay, sorry about that. How will these steps apply to a fingerprint business?
Well, I don't know much about the fingerprint business. But this would apply to any for-profit business, whether it's fingerprinting or not. All of these sources are available.
Okay. Can you type in where on YouTube you can go to find the slides, and we'll ask Stella to put that in the chat for people. And let's see. I'm on LinkedIn. I received a lot of responses from lenders that are willing to assist, but they are all asking for bank account information before they are informing me of an approval. What does this person do?
Well, if your business is not, I'll say this again, if your business hasn't broken even, a bank is not going to lend you any money. So it doesn't matter. You're going to have to get to the point that I said, where you're going to have two reliable sources of repayment before a bank will even legitimately consider you. But let's put it another way. You should be interacting with bankers, all of you. You know that they're not going to lend you any money. At some point, you're going to have to open up a business checking account. So you should begin to formulate some relationship with bankers, because at some point in time, they will become useful to you. And you should work on it now. You can say, hey, I'm going to share a copy of my business plan or executive summary, and you can follow me and that sort of thing. Bankers are always being asked by their bosses, how many businesses are you working with? How many prospects do you have on your list? And now they can put your name on the list, and that's good for them, and they'll take your call. And they'll read stuff, and you can ask them questions. You can ask them, do they have banking relationships with fingerprint companies? Because you want to bank with somebody that understands your business. So there you go.
Okay. Let's see. I think there are a couple more questions in the Q&A. I'll go back there. Do you think a credit union is a good place to seek financing? I have good credit score and my money is in my savings.
Yeah, credit unions are also a great source. They can be a lot more friendly than banks. But again, if you're looking to find capital from a credit bureau, a credit union, before your company actually breaks even, I think it's going to be as much of a challenge as it is to get a bank to lend.
Okay. Can you share a little bit more about SBA loans for owner-occupied real estate loans? What do they look for in a borrower?
Well, if we're talking about something beyond break even, then we're venturing off of the topic here. The only loans that the SBA is going to be involved with in a startup before break even is in the microloan guarantee program. And that's where a CDFI has lent you money to either build real estate, develop real estate, buy working capital or equipment, and then the SBA will guarantee that loan up to 85%. But all the other facilities that the SBA provides guarantee support, the 7A, the 504, all of that, that's not available to startups that haven't broken even.
Okay. There are a couple of other comments. One person is saying that she's currently working with a SCORE representative and she wanted to know when should she start showing her projections to her lender. And I would recommend that she have that conversation with her SCORE representative, but
Yeah, no, and the sooner you do it, the better. I mean, this is not a one-shot deal where you say, here's my, you're trying to work with a mentor over a period of time. And so this is an evolving conversation. So you might start with just, here's my initial assumptions. Before I show you any income statement, let's just talk about, are my assumptions valid? Do they make sense to you? Am I missing something? I think that's a great place to start.
and that pretty much wraps up the comments and the questions that have come in. So
Well, I wish all of you great success and good luck. And like I said, you should get access to the slides, to the Family and Friends Funding Guide, and how startup funding works, the big picture.
okay. I'm not sure if Stella's still on, but I'm going to thank you, Jeff, for the presentation. As usual, we learned a lot.
Well, thank you much.
Okay. Goodbye, everybody.